Good morning, everybody. This is the Live Market Open for Monday, March 28th. I'm Yohay, Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Okay, some of you are still on holiday. Some of you are back to business. It's a long Easter weekend. As usual on the show, we'll talk about the recent developments in markets, or a few, not too many, various charts and levels, the next 24 hours. Perhaps we'll talk about the upcoming things this week as well, not only today. And of course, your questions. You're welcome to enter the chat. If you're seeing the video and not seeing the chat, you can go directly to the address here, tlk.io/fxstreet-forex-live-video. Okay, on Friday, it was Good Friday, the beginning of the Easter weekend. Well, for in some countries, the weekend already began on Thursday. Some countries are back from the weekend, some are not. But Friday was Good Friday. We had on Friday we had the GDP in the United States. It came out better than expected, 1.4%. Expectations stood on 1%. The biggest thing there was personal consumption that went up better than expected, and that's of course good news. Okay. What was a bit worrying was the slide in investment and in corporate profits. Anyway, not such a big difference. The figure is a bit old. Okay, it's a figure for the fourth quarter of 2015. We're already just at the end of the first quarter, so the figures are a bit old, but they still help the US dollar just a bit. If we just look back, and this was the third and last revision, okay? The second one came out at 1%, and the first release, came out at 0.7. So if you compare the first release to the third and final one, it's double. Okay, remember it's an annualized figure, not quarter over quarter. Nevertheless, it's Q4 2015 was not that bad. But as we have begun learning in the past few weeks, Q1 isn't that good. Durable goods orders were weak, retail sales were weak, so it's more, the picture isn't a poor fourth quarter and then a big rebound with momentum for the rest of the year, but actually not too bad, but quite mediocre Q4 and another mediocre quarter in Q1 as it seems at the moment. Okay, we'll get the first figures for Q1 GDP only in a month from now. But anyway, it seems like things are very steady, stable, slow. Depends on how you want to see things out. Okay, so that's Q1 GDP for the fourth quarter came out on Friday. We had, in general, we were seeing very slow moves in markets. Okay, the week began with the US dollar sliding from last week's highs. Again, the moves are very, very limited. It wasn't sheer madness. There weren't really breaking news. It was just a bit better than expected, and we're also seeing today a slow start to the week. Okay, so let's look at the charts before we continue with other stuff. So this is euro dollar. If we zoom out, we can see the big moves that we've seen in recent weeks in March, which was certainly an exciting month. So this is the drag euro dollar falling all the way to the triple bottom of 108.20, rising all the way to 112.15, sliding then again around 110.70, and then another shot up with the Fed's dovishness, and then gradually grinding down. Now, if you look at what we've seen towards the end of last week and the beginning of this week, nothing is really moving too far. Okay, so if we zoom in quite a bit, we're seeing euro dollar strengthening. Okay, in comparison to Friday. And we're seeing this kind of trend across the board, but remember, it's not huge. In this case, thin liquidity implies low volatility as well. So the whole range for this morning is 111.53 to 111.72. This is no more. This is a bit less than 20 pips. Okay, so nothing earth-shattering, but still some kind of a small sell-off in the US dollar. This is better seen here in pound dollar, where we're seeing slightly higher range of, significantly bigger moves of 60 pips to the upside, okay? So bouncing off this support line, which is not that strong anymore, 141.25 all the way to next resistance line at 141.75, okay? But also very much in limited range if we, of course, look at the roller coaster that we had in recent weeks. Remember that last week we had the tragic events in Brussels, the bombing in the airport and the metro station. Unfortunately, terror is striking once again this weekend in Lahore, Pakistan, where scores died in a bombing at the park. Anyway, in the context of currencies, we had these bombings in Brussels, the capital of the European Union, blamed by some on immigrants, even though we know it's not immigrants to blame. In this case, at least, anyway, according to markets, this raises the chances of a Brexit, of the British people voting against remaining in the European Union. Okay, so that's why the pound was hit quite hard last week. It fell all the way from the highs above 145. Well, the fall began over the weekend, but with the resignation of Ian Duncan Smith, which already seems like old news, but this is the big fall right here, in the middle of the week on Tuesday, these bombings all the way to support 140.50, which is a very strong line of support, okay, and also resistance right here. So now we're seeing it bounce back up, okay. Dollar yen, here we're also seeing the dollar slide a bit, but this is just a small move in comparison to the rise that we're seeing this morning in Asia. Remember, in Japan we had a business as usual in trading, so we did see dollar yen rise above this level of 113.10 that we marked last time. Yeah, so now we're seeing it slide a bit. So here we're seeing sort of the opposite, okay, sort of the risk on movements to sell the yen. Dollar yen is moving higher, and then now we're seeing some kind of a slide here. Anyway, the moves also here are quite limited. 113.47 is the current level. The high for today, 113.68, and some resistance at 114. Let's continue. Dollar CAD. We've seen how the Canadian dollar made a huge comeback since mid-January, okay, since these highs, but now it lost some momentum. It made its run its course, especially as last week we had oil prices falling. Oil inventories rose more than expected, pushing oil prices lower and the Canadian dollar lower. So after struggling with this line of 130, we've seen it jump back up. 133 still works as nice support. This morning, once again, we're seeing some kind of strength in the Canadian dollar. It's mostly because of the weakness of the US dollar, falling to maybe we can remove this line, but so we could have support here at 132.20, resistance at 133 for dollar CAD. The better mood in markets, let's jump straight to oil. We're back to $40 a barrel in WTI crude oil. It's a move from the last hour or so, okay. Last week we had it rise to the highs on hopes for OPEC, non-OPEC agreement on freeze in production, a freeze or perhaps even a cut in oil production, and also some falling US production. And then boom, we had this crash once again when we realized that the US shale industry is quite resilient, quite able to act and raise production as prices are rising once again. Now we're seeing a recovery of oil prices and also a recovery of the Canadian dollar, more or less going hand in hand, although the correlation is not always 100%, okay? Anyway, we're currently at $40 a barrel on WTI. 42 remains a high level. I would say, yeah, 38.50, 38.10 is some kind of support, but of course, the battle over $40, the $40 barrel continues, okay? Dollar CAD is, of course, lower. thanks to stronger oil prices. Australian dollar 75.37 at the moment, moving a bit higher on this weakness of the US dollar. Resistance here at 76. The Aussie dollar has become more choppy, not the most predictable currency pair it used to be. By the way, I'm preparing for you a list of new most predictable currencies. It'll be out tomorrow for subscribers of Forex Crunch. Anyway, it's currently Aussie dollar 75.40, 76 is resistance, some support here at 75, which is a very round number. Kiwi dollar still battling the 67 line, moving a bit up, as I mentioned before. Weakness of the US dollar. By the way, the charts I'm using here, you can see the volume levels also on the bottom, this blue cloud, and as you can see, trading volume is quite low this morning. Anyway, 67 works as some kind of resistance, support at 66.20 and 65.50, resistance, high resistance at 68.20. Good morning, everybody. Let's continue with dollar Swiss. More or less a mirror of euro dollar, moving, well, more or less in range. 97.62 is the current level. The whole range for today is 15 pips here. Very, very, very slow moves. 98 works as some resistance. 96.40 as some support. Euro Swiss even, no, more or less the same range as at the 109 handle. At the moment, 109.06 with 109.21 as the high for today. 109.40 as resistance. You can see it separates ranges, but this pair is prone to intervention by the Swiss National Bank. Euro Pound. More exciting, currently at 78.80. It fell from the highs last week when we had higher speculation about a Brexit. We had a break above 79.30, which was the previous high. Of course, the round number of 80 is very strong resistance, but currently we're falling down. 78.50 works as support in case we have extended falls. Euro yen very much in range, rising a bit higher in range on this fresh weakness of the yen in the Asian session. Currently 126.70, 127 is resistance, 125 is support. Was there some kind of intervention by the Bank of Japan taking advantage of low liquidity? Doesn't look like that, doesn't look like the sort of the intervention type, but I must say that in the bigger scheme of things, with very slow movements across the board, the yen is moving a bit more. You can see that also in pound yen, so weaker yen and stronger pound, we're seeing the pair recapture the 160 level, currently 160.76. It just touched the 161 level, it reached 160.99. Okay, so it's trading here. 158.50 to 160 was the previous range, worked very, very nicely. 158.50 was also resistance here, and afterwards support. Okay, if we continue the move to the upside, we have resistance at 162.20, followed by 163.80. Okay, if we have a collapse of this pair and further Brexit talk, 156.10 is low support. Okay, I know this is one of the most popular crosses, the Gepi, the Dragon. Yeah, so we've covered major currency pairs for today. We can always return to any one of these pairs or talk about other pairs, whatever. I'm open to questions as always. Okay, but let's talk about other stuff as well. Let's talk about the events we have today on the agenda. For me, this is the most important one, the core PCE price index. I know it's a mouthful, but this event is the Fed's favorite inflation figure. Okay. First of all, the Fed in the United States, and this is a bit different from quite a few other central banks, they focus on core inflation. They don't care if oil prices go up or go down. They don't care if food prices go up or go down. These are temporary events. They don't impact the bigger scheme of inflation in the medium term. That's why the Fed focuses on core inflation. It doesn't matter that people need fuel, need gasoline for their cars, or eat food on a daily basis. The Fed, contrary to the Bank of England, contrary to the ECB, focuses on core inflation. Now we have a general core inflation figure. That's in general, the basic CPI figure, consumer price index, the general inflation figures. These were already published, but the Fed has its own measure, so to speak. It looks at the personal consumption expenditure, PCE, and also here it looks at the core prices, okay? And this is released today. Let's look at the FX trade calendar on Forex Crunch and understand what we're talking about. So first of all the releases are at 12:30 GMT. As you can see, the time here on the calendar shows the time where I am in Barcelona, Spain, in Central European time. So now that we've had the clock shift over the weekend, it's 2 hours forward. If you're in London, if you're in the UK, in Ireland, in Portugal, it's the time is different, of course. Still 12:30 GMT, but it'll be at 1:30 GMT. So this is the most important figure, highlighted also here on the calendar as an event of high importance. Okay, and this is the one to focus on, the year-over-year change. It's for the month of February, the month that ended, almost a month ago, but it's still very relevant for the Federal Reserve. Last time we had a jump to 1.7% in the core PCE price index, okay? And this time we don't have expectations, but as you can see, here's the graph, okay? So we've seen core inflation, around 2%, and after the crisis collapsing all the way under 1%, rising back again in 2011, and it was around 2%. Then it was sort of here on the ropes around 1%, rising a bit, but not holding ground in 2014, then sliding once again. The Fed was worried. The Fed did like the rise in employment. Employment is growing at a steady pace, more jobs, but not enough pay and not enough inflation. The Fed has two mandates, inflation and employment. Currently, we're seeing it pick up just a bit. So we had it rise to right here to 1.4, and last month in January to 1.7. I'm not sure it'll keep this high ground today. Let's see what happens. We do have the month-over-month figure. Last time was surprisingly strong at 0.3. As you can see here from the chart, it doesn't move too much. It's around flirting with 0.1, 0, 0.2, not going anywhere fast. Last time it jumped to 0.3, the high end of the range. This time it's expected to rise only 0.3 month over month. Okay, anyway, the year-over-year figure is more important. At the same time, we have also other figures always released in tandem, always released together. So we have the personal income figure, how much, what's the level of income, the change in income for Americans after a big jump of 0.5 last time. This time we're expecting only 0.1. We're also looking at the personal consumption expenditure price index. It means not the core figure, no expectations here, but year over year it rose 1.3. Let's see how it moves now. We talked about these figures. Month over month. Personal spending is also important. So last time we had both figures, income and spending, rising 0.5. This time we're expecting 0.1 on both. Anyway, I think once again, the personal consumption, the core PC price index right here is the most important one year over year. In addition, we have a separate release, but at the same time, of the goods trade balance, okay? This is a preliminary release to the general trade balance. We're expecting it to show the same level of deficit, more or less, from 62 billion deficit to 62.3, okay? So that's more or less what we've seen in recent months. Nothing earth-shattering. The United States has a deficit for years in its trade. An hour and a half later, 90 minutes later, at 2 GMT, 4 p.m. here in Europe, or 3 p.m. in the UK, we have pending home sales. This is the last housing figure for February after we had new home sales, existing home sales, building permits, housing starts. This is not a top-tier housing figure, okay? Anyway, it could move markets just a bit because we have thin liquidity, but anyway, it's at we're expecting a rise of 1% month over month, and year over year we had a rise of 1.4 last time, and we don't have expectations this time. Yeah, these are the events to watch out for today. In the United States and Japan, we have some the unemployment rate. Despite all Japan's problems, the deflation, the frustration, the high debt, the level of unemployment in Japan is only 3.2%. It's expected to remain unchanged. We also have other figures there, such as the job applicants ratio, how many jobs per applicant, and other, the retail trade. Anyway, not usually these events don't move the yen too much, but still worth mentioning, okay? Anyway, the big event for today is the core PCE price index. And in general, the United States is not on holiday. That's why we should see, and we have indicators, that's why we should see more action during the US session, especially around 12:30 GMT. Any questions? Anyway, as markets are still not moving too much, let's take another look. No, a bit stuck. Well, we're seeing dollar yen slide just a bit, but nothing really big. Anyway, let's talk about other events we have this week, because it's going to get much busier after this long Easter weekend. So as I mentioned, we still have thin liquidity today, and this results in less action, at least for now. At 12:30, as I mentioned, we have the core PCE price index, the Fed's favorite. Tomorrow, bigger events. Consumer confidence in the United States, a CB consumer confidence, not to be confused with the University of Michigan's consumer confidence. And more importantly, at later on Tuesday, we have Janet Yellen, the chair of the Federal Reserve, talk about monetary policy. The speech is around monetary policy. And we had in this context a very dovish Fed statement, and last week, a very dovish Fed statement 2 weeks ago. This hurt the dollar quite badly. And then we had last week quite a few hawkish comments that helped the dollar recover, from Lockhart, Lecker, Williams, Bullard, which was not expected, and from Evans, which is usually a dove. So perhaps Janet Yellen could provide some clarity, but central bankers try to keep us confused, try not to rock the boat. So this could turn out into some kind of a disappointment. Okay, well, we'll talk about that more in detail tomorrow. On Wednesday, we have German CPI, preliminary figures for February. We've seen that it moved markets quite strongly last time. The ADP non-farm payrolls, which always is always a hint for the non-farm payrolls, not always really well correlated, but still has an impact on markets. Oil inventories, we've seen how that changed the market mood last week with the big rise in crude and distillates and gasoline. On Thursday, we have a speech by Mark Carney. The last day of March is of importance because we also have end of month and end of quarter movements. We also have the Eurozone CPI. Let's see how bad things are here. Canadian GDP. And then Friday, April 1st, April Fool's Day, we have Chinese PMIs. Both are currently in contraction territory. Both are not looking so good. Let's see if they move a bit up. That's the expectations. And of course, the US non-farm payrolls, this time with a short buildup, only with the ADP, but without the ISM manufacturing PMI, without the ISM non-manufacturing PMI, that could mean higher uncertainty and perhaps higher volatility. Okay, so this week certainly warms up, reaches crescendo on Friday, but also tomorrow. Well, all the days feature important events. I have a question here. What do you think about Euro CAD? Let's look at Euro CAD. I'm sure we have it here, right here. Yeah. Okay, currently at 147.88. All in all, well, more or less range trading. They've both moved together against the US dollar. Currently, we're seeing a narrow range. Let's draw some lines here. So 147.60 would work as immediate support, okay? And 148.40 as immediate resistance. Currently, we're moving a bit up after an initial slide. Bigger levels to watch. Sorry. Yeah, let's update these old lines here on the chart. Bigger levels to watch. On the downside, we have 146. On the upside, the round level of 150. Okay. The euro has been moving with the European Central Bank. The Canadian dollar waited for quite some time for the Canadian budget. It didn't feature any surprises, so it moves more with the price of oil. Looking forward, we'll have more and more impact of the British referendum on staying in or out of the Eurozone impact the euro as well, not only the pound, okay? And it could be could weigh on the euro. In addition, we could have well, more talk from the ECB this week with the inflation figures, and but in Canada we have oil prices which are currently a bit elevated. So I have sort of negative bias against both currencies, against the dollar, against each other. At the moment, I see them as quite balanced. We had quite a big fall here. This mostly reflects this rise up here, and fall reflects movements in the Canadian dollar more than in the euro. Currently, things are a bit more balanced. Okay, Euro CAD looks a bit messy at the moment. Range bound. Yeah, I also see it as range bound. I see both currencies equally weak against the US dollar. Okay. So yeah, it's a bit messy at the moment. I don't have a clear bias on this specific cross. Right, more questions? Take the opportunity to ask you guys today. I mean, I assume most of you are in Europe, or I mean, Greater Europe, including the UK, and today we started at the same time in GMT, at 8 GMT, but this is an hour later in Europe. I mean, for me here, it's 10 o'clock. Usually I begin at 9. And for those in the UK, it's 9 o'clock. Usually we begin at 8. So you're in Thailand. Okay. Anyway, my tendency is to shift back to the same time. I mean, not the same time in GMT, but the same time in our local clocks here in Europe. 3:30, so it's the middle of the day. Yeah, here it's 10:30. It's a 5-hour difference at the moment between Central European time and the time in Thailand. Okay. Anyway, no, I think we'll go back, answering your question, Fabian, I think we'll go back to the previous time, I mean, in our local clocks. That means 7 GMT, 8 in London, 9 in 9 here in Central European time. Where are you based, by the way, Fabian? And Albano. And anyway, because that coincides with the opening in London, okay, or in many other European stock exchanges. bourses, so that's my tendency. But of course, with this shift in the clocks, it's always good to ask as well what our regular viewers would like to see. Okay. Yeah, London is closed today, so it doesn't open. But usually it opens at 8 London time, as far as I know. Let me verify that. I don't follow stock markets that closely, but let me check out that. Okay. Let's see, what time is it? List of stock exchange opening times. Wow, there's a big Wikipedia note for that. Let me check them out. So the London Stock Exchange opens at 8 GMT. Yeah. No, 8 local time. Sorry, 8 local time. Okay. Yeah, so... Okay, thanks for your comments. Anyway, I'll discuss the opening time with my colleagues, and we'll of course let you know via the FX Street webinars pages, okay? Consult with Adinda and Mauricio, and you'll have all the data on the FX Street webinars page, where you can always... Okay, this is the FX Street webinars page. Pasting it right now. All right. We'll probably start as usual. Okay. Any more questions or... Let's just do some recap of what we had. Well, let's look at this. You always like to show the implied probability of a rate hike. The next rate decision is on April 27th, a month from now. 12% chance of a rate hike. That means no chance, basically, because there's also no press conference. Anyway, in June, the jury is mostly out. A high chance for no rate hike, but it's still an open question. If we have good figures this week from the non-farm payrolls, especially wages, which are growing in importance, we can still have a rate hike in June. Afterwards, according to bond markets, the next rate hike will be in July, but there's no press conference. And in September, I think it's just too close to the general elections in the United States, to the presidential elections and Congress and everything. So I don't expect a rate hike, not in September, not on November 2nd, which is just on the week of the elections. More likely, if we have a hawkish Fed, we can expect a move in December after the elections and perhaps in June. But that's, of course, data dependent. Last week, we had a few Fed officials talk about April as a live meeting, not only live, but also as a good chance to see a rate hike. Nobody believes this. And then we had, of course, the some weak figures as well, such as the durable goods orders to take the hot air out of the wings of the US dollar. And you will see how this thing develops later on. Okay. I've already mentioned the US elections. we had just a few primaries over the weekend in the United States, only in the Democratic Party. So Bernie Sanders won huge victories in Alaska, Hawaii, and Washington State, which he was expected to win. And these are not such big states. So he narrowed the gap against Hillary Clinton in the Democratic race, but she still has a significant lead. The contest is still open, but let's see. Currently, it's Hillary Clinton leading in the Democratic Party and Donald Trump in the Republican Party. There are many all over the world, and also in the United States, of course, fear the day in which Donald Trump could become the president of the most powerful country in the world. He has many conflictive statements, to say the least. And yeah, and I had a conversation over the weekend. He's on one hand not dependent on political donors, means he can do whatever he wants in theory, okay? On the other hand, you don't really know what he's going to do, because he says one thing and the other at the same time, and he says, including some dangerous stuff about putting up fights all over the world, building a wall that Mexico will pay for, something so unrealistic. Anyway, I think this could have some negative impact on the market mood if it becomes clearer that Donald Trump becomes the nominee for the Republican Party. He's already the front runner, of course, but we could still have the Republican Party go against the popular vote and decide to nominate someone else, even though he'll have the plurality of votes. And of course, as the elections draw near, and he's a candidate, we'll have uncertainty moving the market mood. Remember, markets want certainty. They would prefer either Hillary Clinton, which is seen as continuing the path of Barack Obama, or one of the more moderate Republicans, such as John Kasich, which has no chance of winning a majority anymore, or the others which have already retired, such as Marco Rubio or Jeb Bush or one of these guys. And these are more mainstream candidates, more continuation. They do not want Donald Trump, which is a wild card, or Bernie Sanders, which is, of course, more moderate and not warmongering, but is not a mainstream market-friendly candidate. So there's still a lot of time to go. 7 months until the elections, and 9 months until the new president elect will enter the White House. And in the United States, there are lots of checks and balances. Of course, the president cannot do just anything he or she wants. So there's Congress. Anyway, but as it's the most powerful country in the world, most powerful central bank as well, and anything can happen, and the speculation so far hasn't moved markets, but I think that in the second quarter will have a bigger effect. We have more primary contests, the final ones. Primaries end on June 7th, okay, in both parties, if I'm not mistaken, and then we'll have a clearer picture. We have quite a few big states already in April, with New York, for example, and so this will take more and more. This will take center stage. The next primary contest is in Wisconsin, I think, in a week and a half from now. So now we have a sort of a break from US politics, but then I think it'll return full steam and also impact markets. Okay, it was just news over the weekend. The Sanders campaign gained some momentum. Again, he's still the underdog. Clinton is still leading. Okay. Let's take another look at charts. See, well, not much of a movement. Anyway, yeah, so let's get to the wrap-up for today. This is the wrap-up for the live market open for Monday, March 23rd. Let's see what we have in markets. We have a general slide of the US dollar from last week's highs, But in general, the moves are quite limited, quite a slow start to this week. Very, well, it's not surprising at all. It's a long Easter weekend. Good Friday was slow. We had, and now it's holiday in quite a few countries, but the United States is not on holiday. On Friday, we had GDP coming out better than expected in the United States. That's the final read for Q4, 1.4% better than expected. We now know that Q4 wasn't that bad, but we also learned last week from quite a few figures that the first quarter isn't so good. So if you're looking for any kind of momentum in the US economy, it's hard, very hard to see it at the moment. At least it's not slowing down. Today we have quite a few releases in the United States. We have the most important one is the Fed's favorite inflation measure, the core PCE price index. It stood on a strong 1.7% last month. This time we don't have expectations for year over year, but the rise month over month is expected to be slower. Okay, 0.2 instead of 0.3. We also have personal spending and personal income. If all figures move in one direction, for instance, if they're all positive, it's positive for the US dollar. If all of them move in the other direction, negative, it's easy. That's the straightforward case. The not so straightforward case is if we have mixed figures, and then I would focus on the core PCE price index. We also have pending home sales at 2 p.m. GMT. Okay, let's look at a few charts. See here a question, I'll get to that at the end, just cover a few charts. Euro dollar rising, this reflects the weakness of the US dollar in the new week, but the movement is extremely shallow, narrow, 111.70, resistance at 112.15, support at 110.70. I don't think we'll have a challenge of these ranges today as it's a slower day. Pound dollar, more exciting this morning, 141.72 is the current level. 141.75 is some kind of resistance, followed by 142.40 support at 140.50. Very strong double bottom. Dollar yen a bit sliding at the moment from the highs. It made a move to the upside in the Asian session. Resistance at 114, support 113.10. Dollar CAD sliding, stronger Canadian dollar alongside stronger oil prices with WTI crude oil just slipping under 40 as we speak, but it already traded above 40. Bouncing, and last week it was hit by higher inventories. So support here at 132.20, resistance at 133. Aussie dollar a bit more choppy, 75.35, resistance at 76, support at 75. And the Kiwi dollar hugging the 67 level, 66.20 and 68.20. Are lines to watch. Question here. There's a question in the YouTube chat from Joseph Gio. I'm not following that. Sorry. Please write your questions here. Anyway, I'll still answer this question, of course. What's the reason for interest rates or QE if central banking governors like RBA's Stevens could simply talk up down the currency value? Well, in general, central bankers prefer to talk and not act. Well, they're human beings like everybody else, okay? So they'd rather not keep their ammunition, their powder dry, the tools in the shed, whatever you wish, in order to really deploy them when necessary, only to scare markets when they want to, and not shoot, okay? In the case of the RBA, they would like a weaker currency to make the commodities that Australia exports cheaper. To make them more attractive and provide more income in domestic currency, and also other stuff. It can help other parts of the economy. It also makes Australians prefer buying local products instead of more expensive imported products. When the Australian dollar is strong, imported products can be more attractive. So usually the central bankers try to talk down the currencies, okay? When they do talk. When they don't have any other choice, when they have exhausted this verbal intervention, they do try to, they do shoot, okay? So, well, we didn't have a rate cut in Australia for quite some time, but in New Zealand we did have recently a surprising rate cut, and that hit the Kiwi, of course. Yeah, so central banks, currencies move by expectations, but central bankers can guide markets, can guide currencies by talking, but eventually you can't just talk. You can't just, let's say, wave with the rate cut without really cutting the rates, because then nobody will believe you. The power of verbal intervention is the credibility. Okay, so there's a limit to how many times they can cry wolf without acting, of course. Okay, well, I hope that answers the question. Anyway, thank you very much, everybody, for coming this morning. Slow morning to start the week. It gets much busier later on, I'm sure. Yeah, drug effect certainly is a great example of what we've seen about talking. Yeah, in this case, the ECB introduced a huge stimulus package, but then Draghi said, we're done for now, in other words, and that turned everything around. Anyway, thank you very much, everybody, for coming. Wish everybody a safe and successful trading day. We'll be here tomorrow. Watch out for the time of the show on the FX Trade webinars page. And that's it. So see you tomorrow, and bye-bye.